Good morning. I'm Kristen Lessard. Tax Time's here again. Are you ready? Well, here to help us out is Laura DaLomba from KLR Certified Public Accountants. Good morning, Laura.
Good morning.
All right, so when we go to file our taxes this year, are there any changes that were made for 2012 that we should know about?
2012 tax laws look very similar to 2011 because we had an extension of all of the tax breaks that were passed in 2001 and 2003. Those tax cuts that were supposed to sunset at the end of 2010 were extended through to 2012. So there's not a lot that has changed between 2011 to 2012. There were a few breaks that expired at the end of 2011 that have since been reinstated for 2012. So there's really not going to be a lot of big changes with 2012 returns compared to 2011.
Well, that's good news. Well, now, what about looking ahead to next year? What tax changes are there for 2013 for when we file next year?
Well, next year there's going to be a bigger set of changes. Obviously, the 2012 American Taxpayer Relief Act was signed into law on January 2nd this year. And really, the biggest set of changes are going to relate to the high-income taxpayers. And for the purposes of this act, high income would be individuals with adjusted gross income of $400,000 or more, and married filing joint folks whose adjusted gross income is $450,000 or more. And the two big changes are, one, the old 39.6 income tax rate has been reinstated for those high-income taxpayers. And also, the capital gains tax rate has been increased for those taxpayers from 15% to 20%. Now, in addition to those two changes, there were two changes that are coming into effect for 2013 that are related to laws that were changed in 2010, the Health Care Act. And that's the 3.8% Medicare surtax that will be added on to investment-type income and rental income, and the 0.9% tax, Medicare tax, that will be added on to wage income. And those, again, are going to affect the higher-income taxpayers, but the threshold for those additional taxes are $200,000 for individuals and $250,000 for the married filing joint folks.
So a little bit lower.
Yeah, a little bit lower threshold on those, and it's those are payroll tax additions, so it's not going to hit as hard on the income tax side, but the payroll tax, you'll see a little bit less in your paycheck if you're in those income thresholds.
Now, what is the child tax credit amount for 2012, and does that change for 2013?
For 2012, the child tax credit is $1,000 per child. For 2013, that was scheduled to drop down to $500, but with the new Tax Act, the Congress changed that to stay at $1,000, and that is a permanent change. So going forward, the child tax credit will still be at $1,000 per child.
Okay. Now, can you explain the alternative minimum tax? Who's affected by it, and will it affect more people in 2013?
The AMT, that's always a fun one. The way I explain that to people is you have the regular ordinary income tax system where you figure out your tax based on all of those rules. And then there's the alternative minimum tax system where you have to figure out your tax based on those rules. And basically what the AMT is, it basically disallows certain deductions that you are allowed on the regular system. For instance, state income taxes, real estate taxes, unreimbursed employee business expenses is another big item that gets disallowed. So once you figure out your tax, when you take those deductions out of the mix, you compare the two numbers, the two bottom line numbers, ordinary tax versus the AMT tax. And if the AMT tax is higher, then you pay the difference. So that's what your AMT tax is. The people who are affected by it, there is an exemption of income amount that is allowed. So for folks that are single that have income of $50,600 or less, they're fully exempt from the AMT. Married filing joint, the threshold is $78,750 for 2012. Those people would be exempt.
Do you have to go for... go ahead.
Anyone over those thresholds, I'm not saying they're definitely going to be subject to AMT because it really depends on what their deductions are. So if they have a lot of those real estate tax deductions and state income tax and unreimbursed employee business expenses, it's likely they will get pulled into the AMT mix.
Do you have to go for training and continuing education because the tax laws are always changing?
Constant.
Yeah.
We have to have at least 40 hours of training each year just to stay up to date on all the rules.
Is there an age limit on claiming a child as a dependent?
You know, there is a limit for claiming a qualifying child, and that would be age 18 or 24 if the child is still a full-time student. However, if your child is older than 24, there's still a possibility that you can claim that child as a qualifying relative. And the way you could do that is if you as a parent are providing more than 50% of your child's support, which probably is not difficult to do in this day and age, and that child has earned less than $3,800 for the year, which if they didn't have a job, that's possible, then you can still claim that child as what's considered a qualifying relative.
Okay.
So if they meet those thresholds, then you can continue to claim that child as a dependent even after age 24.
So that could mean a handicapped child, maybe an elderly parent as well?
It could. For handicapped children, if they are permanently and totally disabled, there is no age limitation there. They have to be permanently and totally disabled, and the parent has to have provided more than 50% of the support.
Okay. Now, there's a college tuition tax credit, correct?
There are 2 college tuition tax credits and a deduction related to college tuition payments. The first one, which is probably the most beneficial one, is a maximum credit of $2,500 per child that is in school.
Okay.
That's called the American Opportunity Tax Credit. And the good thing about that credit is up to 40% of it can be refundable. And what I mean by that is normally tax credits are what's called non-refundable. So the credit will offset your tax liability, but if the credit is more than your tax liability, you won't get the difference back. Now, when it's a refundable credit, that means that even if your tax liability is $0, but the credit is, let's say, $1,000, you'll get that $1,000 back as a refund.
Okay.
So you can, with the American Opportunity Tax Credit, you could potentially get up to $1,000 more back in addition to what your tax liability, in addition to offsetting your tax liability. So that's probably the best one that's available out there, but it's only good for the first 4 years of post-secondary education, and you have to be enrolled at least half-time. There's also the Lifetime Learning Credit, which would help the folks who are perhaps in graduate school or just taking a few classes at a time. And that credit is a maximum credit of $2,000 per return, and it's based on it's available for 20% of up to $10,000 of expenses. So those are the 2 credits that are available for tuition. There's also a tuition deduction, which allows you to deduct up to a maximum of $4,000 on your return. Now, a deduction isn't worth as much as a credit because the deduction's only going to be based on whatever your tax rate is. It's a percentage of the deduction. There are income phase-out thresholds for those credits and that deduction, though. So people who are in a higher income bracket probably won't benefit from these credits.
Okay. Now, my son is going to be going to private high school next year. Is there a credit or deduction for that?
Unfortunately not. The government has decided
Bummer.
they're not going to subsidize people sending their kids to private school. So you're going to have to foot that bill yourself.
Darn, that's not fair. Well, because I know there are tax credits or deductions for daycare and preschool, because I've had that in the past with my children.
Right. Those are available, but unfortunately private high schools wouldn't qualify.
Oh, not right. For those who had damage to their home or business last year from Superstorm Sandy, can they claim the cost of repairs on their 2012 taxes?
Those folks are allowed to claim a casualty loss for the amounts that aren't covered by insurance. So if their insurance policy didn't cover the full amount, they can claim a casualty loss. For the people that were in Newport and Washington counties, those counties were federally declared disaster areas by the president. So they have an option that they could actually treat the loss as though it happened in the year preceding Superstorm Sandy.
Okay.
So what that does is it lets them file an amended return for 2011 now and get the refund quicker rather than waiting to get all their tax documents and wait to file their 2012 return.
Mm-hmm.
So there is that option that they can file more quickly and get any refunds that they'd be due on a quicker basis.
Every year when I go to my CPA to have my taxes done, I forget something. Can you give us just a little checklist of what everybody should have with them when they go for that tax appointment?
Well, when you go for your tax appointment, you want to make sure you have all the tax documents that have been mailed to you, the 1099s for your interest and dividends, your W-2, mortgage interest. Remember to bring your real estate taxes if you own a home, your car taxes. Those two items, usually I end up having to call my clients and say, you forgot to give me this. Charitable donations, right, things like that. And if you have any expenses that you weren't reimbursed by your employer, those types of things, you should remember to bring those.
Do most people e-file these days?
Most people do. Any accounting firm pretty much is required to e-file returns for our clients now because there are mandates at both the state and federal level that says if you file so many returns in a given year, then you must e-file those returns.
Okay.
And really, it's the best way to file them because when you file a paper return, you have somebody on the other end at the state or in the federal level keep punching in that return, and that can create errors. So e-filing is the safest, most secure way to send it in, and it's always the quickest way to get refunds as well.
Yeah, how fast can you get that refund back when you e-file? It's pretty... If
you e-file and sign up for direct deposit, you can see refunds within probably 10 to 21 days, if not sooner.
I like
it's
that.
It's much quicker, yes.
Well, some great advice. Thank you so much, Laura DaLomba from KLR, Certified Public Accountants. Thanks for joining me this morning.
Thanks for having me.